Welcome back to part 2 of Financial Terms Explained. If you missed part 1, go watch it. It's like the appetizer to this main course of finance. Let's dive in and make sense of more money talk.
Brother,
Your net worth is the value of everything you own, minus what you owe. In other words, it's a snapshot of your financial health. If your assets, like a home or savings, are worth more than your debts, then you have a positive net worth. Basically, you're winning the money game. But if your debts are bigger, well, you're in the oops zone. Amortization is like paying for a fancy new software or patent in monthly installments, instead of all at once. It's for things you can't touch, like trademarks or ideas. Unlike depreciation, which is for stuff you can kick, amortization spreads the cost over time. So companies can take a little bite each year instead of swallowing a giant expense. Capital markets are like the big shopping malls of money, where buyers and sellers trade things like stocks, bonds, and other financial goodies. There are 2 main sections: the primary market, where brand new securities are sold, and the secondary market, where people swap their old securities. It's basically the marketplace for anyone looking to score some investment deals. Profit margin is how much money a company keeps after covering its costs. You get it by dividing how much money the company actually makes by how much it brings in from sales. The higher the profit margin, the better the company is at turning sales into actual cash. EBITDA is a measure of a company's profit from core operations, excluding interest, taxes, depreciation, and amortization. It shows how much the company earns before these costs are considered. Investors use it to assess a company's profitability and compare it to others in the same industry. A Fico score is a type of credit score used to assess your credit worthiness. The score ranges from 300 to 850 and takes into account your payment history, how much credit you've used, and how long you've had credit. The higher the score, the more likely you are to get a thumbs up from lenders, and maybe even a lower interest rate. So, treat it like your money report card. Bonds are essentially loans you give to companies or governments. When you buy a bond, you're lending your money in exchange for interest payments over time. After a set period, the issuer repays the full bond amount. You can also sell bonds to other investors before they mature. Stocks represent ownership in a company. When you buy stock, you own a small piece of that company. Stock prices fluctuate based on the company's performance, market conditions, and overall economic factors. If you want to keep leveling up your financial game and dive deeper into the world of money, don't forget to hit that subscribe button.